the rest of it. So you're very much seeing, whereas these things were incredibly useful and in fact gave America a leadership position, it feels like the US has kind of cashed in on that leadership position, and now it's struggling to maintain that because, like sanctions and like a whole bunch of other things, it's something that you can only use once, and then you start losing control because people want to go their own way. It stops becoming beneficial for everybody.
I mean, just really quickly, tying together two of your points, which are both very pertinent, is first of all, I don't understand why they haven't figured this out yet. Like, you're not, by kind of using this as a geopolitical, arm twist or whatever you want to call it, like, it's not working. Like this has only been a really serious organization for less than, for what, 15 years, really? And you want to kind of just spend all of the capital down to achieve literally nothing. Nothing will be achieved through this. And all you'll do is lose the leverage you have by having a central role and by having created that organization. It's such a lose-lose proposition. There's no upside to this. And I don't understand why Western leaders haven't started looking at this and saying, what we're doing is fruitless, and we're piddling away what left we have in terms of leadership capital through these institutions. The second thing I'd say quickly is this is going to come back to bite us, because we discuss on the show all the time that we probably will have a financial crisis in the next few years. The housing markets look shaky, the financial system's a bit rockety, all that kind of thing. There's at least, I think everyone knows that there is a significant risk of another financial crisis. That financial crisis could easily be global in nature, just like it was before. And what are we going to do when we find that the G20's not working? Because that's what it was set up to do. I mean, maybe the optimistic case is that if we have a financial crisis, that there'll be so much pressure that we'll have to kind of get the old band back together, go along and just sort things out, and maybe it'll be good for international diplomacy. But you're running a huge risk spending down the political capital of this organization so late in the cycle with shaky housing markets and so on.
Hurry, Kirin.
Yeah, the news in the past week about microchips in China has been very, very interesting, and I think it's now become so obvious that strategy that was only put together a few months ago. I don't think it's even been a year, really. Maybe it's been just a year, when the US put together this entire kind of China containment strategy, economic containment strategy, that's not actually an economic containment strategy. It's just a kind of slowing strategy. Never communicated properly. And, if things aren't communicated properly, maybe it's because it's not a very clear idea. I think that has now hit the ultimate wall. It's becoming utterly impossible to ignore. A new smartphone was released by Huawei, and it's pretty much a top tier 5G smartphone. From the reviews that I looked up before the show, it basically compares to an iPhone 14 Pro, which my understanding is the ultimate Apple model. The whole idea behind a lot of these chip bans and so on has been to hobble China's ability to make, at the time that this phone was just released onto the market. And then Bloomberg, I think the story is that Bloomberg got their hands on one of them. They just bought one from AliExpress or eBay or something, and they stripped it down, and they said, yeah, it looks like they've got a 7-nanometer chip. So we can go into a moment what the response has been to this in the West, but I think we can certainly say that our skepticism around these chip bans and sanctions is becoming more vindicated every day.
Yes, I agree with that, Philip. I think one of the things that the last year is showing us is that some of our prognostications, without giving ourselves too much of a pat on the back, are proving increasingly accurate. I just want to rewind a little bit, a few years, if it's possible, though, because, of course, the chip bans against China of the last year have been very much in the news. And I think that it's easy for people to forget that Huawei was actually the canary in the coal mine for this 3 years ago, or 4 years ago, probably now. So what happened was Huawei had a burst through the global smartphone market. A lot of their phones had a fantastic offering in terms of the raw hardware, the camera, the quality of the microchip, the amount of RAM, the quality of the screen, all of that sort of thing. And in many ways, their phones outstripped both Samsung and Apple, which dominated the smartphone market at the time. And because of that, they were taking an increasing share of the global smartphone market. I think that was bad enough, and there was a lot of discontent about that. I should say it wasn't just perhaps because they were taking the share. Some people might argue it was, but I think there was also a lot of security concerns. Whether they were founded or not is another matter. I won't get into that. But really, I think the straw that broke the camel's back was when it became clear that Huawei had developed a full 5G tech stack quite a few years ahead of their Western rivals, ahead of the US and Scandinavian rivals, which were the two rivals to develop 5G systems in terms of the mobile phone communications towers and all of the rest of it. And Huawei were way ahead, and they started signing contracts, and there was a certain panic. Now, the official explanation was that it would give Chinese security because of the nature of the way that large Chinese companies are organized with members of the Communist Party of China on their boards of directors. It would give the Chinese security services access to backbone telecommunications within, say, Britain, where we had a huge debate about whether to let Huawei build out our 5G or not, or within the US or elsewhere. The other side of the coin, of course, or the other argument would be that it was simply a case of the US did not want China to become the benchmark in this sector, because it's not just capturing the sector in terms of then, all of the business that, say, Cisco Systems would lose out on in the US because they wouldn't be building out this stuff. It would also be the ability to set standards and protocols for the system. And that, pertaining to our previous conversation with regard to the G20 and US influence and US leadership, has been one of the key levers of US influence, is their ability to set standards and protocols in key industries within the global economy, and actually to control a lot of the hardware and the software that keeps the global economy running. So that would be the other argument. But either way, the US had a lot of its allies kind of cancel orders or back away from potential orders to give Huawei this kind of 5G build-out contract. And it also started imposing quite heavy sanctions. And one of those sanctions was to ban the sale of high-end 5G chips to Huawei. This immediately put a huge dent in their mobile phone section, because people think it's just mobile phones, but actually it's almost a full suite telecommunications company. But for their mobile phone segment, it was devastating. I think their sales fell by half within a single year in the smartphone segment. And it was a segment, as I say, where they'd been making tremendous gains. However, it's only taken them 3 years to catch up. I'm not sure if they're fully caught up yet, but it's only taken them 3 years to get to a 7 nanometer 5G chip that's fully domestically made and installable and going out onto consumer markets, freely available to everyone. Does this mean that Huawei is going to now surge back to where it was in the mobile phone market, where it was really looking as if it would start to challenge at least Samsung, but perhaps even Apple as well? I don't know. But the key thing about this story is that it's an obvious benchmark, an obvious guidance to what's going to happen with the most recent chip bans, which was the ban on the sale of chips to China above a certain tech level or below a certain nanometer level. 3 years seems a reasonable time for China to be able to develop its own ones. It's also been banned from buying the high-end lithography machinery, which is, like really precise and specialized stuff. It comes from ADSL, I think, in the Netherlands, and they're banned from buying that. But they're still selling them now because the ban doesn't come in until September. But anyway, I think 3 years now becomes the benchmark of when we can expect the Chinese to catch up. After that, they might be a year, they might be 6 months behind, but I don't think it's going to make a great deal of difference to their economy. And in fact, once they catch up, because of China's excellence, can we say, or because of China's ability, shall we say, to produce stuff, whatever that stuff is, at a lower cost for the same quality as anywhere else in the world, one can expect not just them to catch up and therefore negate any benefits that the US and the Western world might have had for hobbling the Chinese economy technologically. Not only that, but we could also expect them to start eating in to the market for Western chip manufacturers and Taiwanese chip manufacturers, because now they'll have their own industry, and history tends to tell us that the Chinese do extremely well in catching up and then bettering their rivals on cost.
Yeah, I think it's worth emphasizing the catch-up point. I have the same feeling as you. If you turn around, basically 3 years ago, turn around, throw a spanner in the works, you're not producing 5G anymore. And now we see that it's about 3 years to catch up with that. It won't be 3 years next time. Every step you take here, you will shorten the distance because you're just incentivizing for them to develop this stuff. I mean, how long would it have taken them to develop domestic 7 nanometer chips if they hadn't had the ban imposed? My guess is significantly longer than 3 years, because the incentives to do so would have been much lower. So what you're doing with this, we've pointed out a million times on the show before, is you're getting a short-term result, but in the long term, you're undermining your own position of power. It is so incredibly short-sighted. I'm shocked that a government would do it. Even if a company did this sort of tactics, market strategy, I'd say that's very unusual. That company should have CEOs that have a longer term game plan. But the fact that a country is using this as a strategy is really mind-bending. I mean, just, I suppose before we leave it, it's interesting to know what the response to this has been in DC, because one thing that I add to your otherwise very good history of this is that a lot of countries had to be dragged into these bans, both on the domestic 5G infrastructure and definitely on the export bans on chips and so on, and lithographic machines. They had to be dragged into a kicking and screaming. They didn't want to do this. Countries, because not just were they losing out on the business, not just were they losing out on a cheaper 5G infrastructure, but when somebody tells you to stop doing business with a trade partner, you start asking yourself, well, how deep is this going to go? What are the limits on this? Are you going to just keep asking me to do this? So countries obviously get very, not just countries, businesses get very anxious about that. So I was interested to see, okay, well, what's the response been to the development of this chip? There was a long, very detailed and quite good article in the Washington Post. I think it was yesterday or the day before. And basically they had kind of an expert interviewed, and he basically says, yeah, it's not really that surprising that this happened. He said they're going on the speculation that the Chinese haven't developed the extreme ultraviolet lithography machines domestically. Now, they may have, we don't know, because China hasn't told us what we're doing. But he's going on that assumption, and he's saying, actually, you can, if you're quite good at it, use the older machines to get 7 nanometer chips. You just have to run the process, say, 4 times instead of 1 time. So I'm kind of reading this and I go, okay, so the experts knew that this was a technical possibility. And just let me read the paragraph here that follows that. I guess they're quoting this expert here. They say, there is a downside. This increases the number of tools required. 4 sets instead of 1, raising the cost and slowing manufacturing throughput. Yet such extra expenses are marginal and can be ameliorated by efficiently managing the production process, end quote. Okay, so they knew all this? They knew that it was possible to do this, and they still did this ban that in the long run massively incentivizes China to completely onshore this entire production process. I mean, it really feels like there's maybe a slightly short-term plan here, but there doesn't seem to be any long-term plan here at all. It's very, very strange.
Attention, deficit disorder. I read an article in the Washington Post this week that absolutely knocked my socks off. I could hardly believe it, actually, and I'm amazed that it hasn't generated more traction. Basically, the Washington Post reported that in 2023, this year, the US budget deficit, the gap between government income and government expenditures, is going to double to $2 trillion. Now, that sounds like a big number, but the US economy is enormous as well. The key figure here, though, is that the fiscal deficit, the budget deficit, as a percentage of GDP, which is really the number that counts, not the nominal size, 1 trillion, 2 trillion, 500 billion. No, it's the percentage of GDP that counts. This year is going to be almost near enough 8% of GDP. And that really absolutely blew my socks off. That is an unprecedented number for essentially any time outside of real economic crisis. I don't mean like a recession. I don't mean like a really bad recession. I mean a genuine economic like meltdown, i.e. the Great Depression or the global financial crisis, or a war, like a serious total war, not like Vietnam, not like Iraq, but total war. Outside that, figures of 8% of GDP are just unheard of. And the thing is, this isn't a recession. It's not a sharp recession. It's not even a shallow recession. The US economy is set to grow at over 2% this year, by over 2% this year. Unemployment is incredibly low. In fact, it's so low, the Federal Reserve thinks it's having a push effect on inflation. And yet, the budget deficit is at 8% this year. Now, you know, to give people an idea, during a recession, budget deficits tend to go up. And the reason is that during a recession, less business gets done, people buy less, there are fewer jobs available. So tax revenues go down. And at the same time, the government has to spend more on things like unemployment benefits and other social security related issues. So, you know, their spending increases, their income decreases, so the deficit goes up. Not as far as 8%, but it still goes up. Meantime, in good times, when the economy is growing, like now, people have more jobs, they get paid more, they spend more in shops, tax revenue goes up. They don't need unemployment benefit, they don't need other social security and social safety net things. Expenditures go down, so the deficit contracts or hopefully goes into surplus. You have a budget surplus. So, I mean, 8% seem. Now, I'm not an economist, so I might be reading this and thinking, whoa, that is a horrendous level. It's unprecedented. It seems way out of whack with what would be normal for a healthy economy. But I'm not an economist, Philip, so maybe I'm getting it wrong here because I don't see any great terror or even much hand-wringing about it. This story came out in the Washington Post a day or two ago as we're recording this, but probably 4 or 5 days ago as people are listening to it, and haven't really heard much about it. So am I getting this wrong, Philip? I mean, is this a horrible number, or have I just missed the point here?
No, I think you've got it precisely. I mean, it's really hard to exaggerate how odd the current fiscal situation in the US is. You said that the economy's doing quite well. I mean, growth has been quite slow, but as far as the unemployment rate goes, we haven't seen unemployment rates this low as they are now in the United States since the late 1960s. And that was at a point when the government was spending a lot on both social programs at home and on the Vietnam War. Now, that didn't mean that the government was running a big government deficit. In the late 1960s, when there was no recession, prior to, I think, the recession start in 1971, it could have been 1973, I can't remember. Prior to that, the government was running roughly a balanced budget. So the first question you have to ask is, where is this money going? Because if there's a deficit in one part of the economy, that means that there's a surplus in another part of the economy. It's just a kind of an accounting relationship, an accounting identity. So the question is where this is going. And when you think it through, actually, you find that you can actually dust off the old post-war Marxist macroeconomic literature here. So there's only really two places that this government deficit can go. It always now, just to be clear, a government deficit always accumulates as savings elsewhere in the economy. So if the government's borrowing more than it's spending more than it's taxing, it's pushing a lump of money in. You can think of it that way, and then it's issuing a bond into the markets. They're often bought by the central bank. So where are those going? Okay, well, the first port of call is usually outside the country. So you might get, in times of relatively high growth, a large government deficit if there's a big trade deficit, because a trade deficit is someone else's trade surplus, right? So they're accumulating money from you and you're running a deficit with them. This time around, yeah, the American trade deficit is not great. It's about minus 3.7 of GDP, and it's the worst that it's been since the 2008 crisis. It's not an insignificant trade deficit by any stretch, and that does account for where some of this money is going. But it's not at record levels. I mean, the highest the American trade deficit reached was in 2006. It was minus 6. So the trade deficit it explains some of it, but it doesn't explain all of it. So the only other two places that could be accumulating these claims are the household sector and the corporate sector. And there may be a little bit of household savings accumulation. There definitely was during COVID. But I think a lot of that's been wound down as prices have started rising and people have been drawing down on their savings and even going into debt with credit cards and so on to keep up with the inflated prices. So then there's only one other place that all that money will be going, and it will be into corporate savings. Translation, corporate profits. And of course, corporate profits are insanely high right now. Profit margins in the US, I think they're at a record high. Now, that's where you come to the old Marxist stuff. The Marxists used to always say that you could have a crisis of capitalism where companies would be falling into some sort of a horrible depression state, or their profits would dry up and all these companies would go bankrupt. But there was one way when the economy gets really full of, as they'd say, contradictions and things were really, really bad under the surface. There was one way of propping up those profit margins. It's for governments to run deficits. Now, I'm not saying I believe in Marxist explanations of crisis of capitalism. I think some of them have merit, most of them don't. But the Marxist analysis here feels strangely correct. The corporate profit margins are being propped up by huge government deficits. And of course, the corporate profit margins being propped up are ensuring that stock markets don't collapse. Stock markets aren't in a great spot right now, but the one bright data point on the horizon is margins are nice and high. The earnings that feed into stock market analyst expectations are relatively high. The problem is this can't last because, and this is where the Marxists are wrong, it's not often some sort of crisis of capitalism where it's a crisis of profitability. It's actually usually the way an economy crashes is something like it's the household sector crashing and construction jobs drying up. We've talked about this many times on the podcast before. That does appear to be happening at the moment. The housing market is very weak. Prices have fallen. New builds are down. There's all talk of a corporate crisis in the corporate property sector due to overextension, overpricing, but also due to work from home phenomenon. When that all comes down, if and when it all comes down, you'll get the recession regardless. And then what'll happen is you'll have an extra additional government deficit piled on top of an already high one. So if the government deficit currently is over 8%, tax revenue will fall, property tax revenue, income tax revenue from people being laid off, and unemployment claims will go up. People will start claiming the dole, and that'll all have what's called an endogenous effect on the government budget, and the deficit will go even higher. And that is the most likely scenario that we're heading into.
That sounds astonishing. That, the idea that, these numbers to me anyway, and as I say, I'm not an economist, which is why I asked you whether I got this wrong, but from my perspective, these are the sort of numbers that you would expect to see in a kind of a basket case 1970s South American economy. A budget deficit of 8% at the peak of the economic cycle, just as it seems that you're about to go into recession and blow things out even further. And on that subject, by the way, I also saw a chart today that showed that the investment purchases of housing in the US decreased by 45% this month, and we are now at a lower point in terms of the declines or the sales of investment housing. We're now at a lower point than we were in 2008. And as I say, we've covered extensively on the Multipolar podcast the difficulties in the housing market, corporate housing, and also residential housing, and some of the issues with regard to real estate in the US, and how it all seems like it might be getting set to go pop. And this chart that I saw, which showed a 45% decline in investment purchase of properties, would really suggest that, well, it's another supporting indicator that it might be going that way. And not just in the US. I don't want to single out the US. The UK, my own country, is in a similar position in terms of that. But one would have thought that if you go into a recession with a deficit of 8% of GDP, if even a mild recession hits, that's going to blip up by another percentage point or two. And if it's a really serious recession, could be in trouble, a great deal of trouble indeed. Just to pick your brains, what sort of effect could you imagine that having? And would it be sustainable? I mean, the US under Trump, had deficits every year despite fairly strong growth, 4, 5, 6% every single year of the Trump administration. Of course, then you had the COVID period where things really blew out to pay for lockdowns and people staying at home and all of the rest of that. 2022 was a bit of a recovery, but now we've had the doubling back to 2 trillion, which is 8%. And we look set to hit a slowdown at the very least, a recession more likely, a really bad recession, possibly. I mean, how bad could it get? What would be the effect on US interest rates? Because if you're suddenly having to sell way more debt to cover your budget deficit, the general tendency I would have thought would be for that to push up interest rates. Like the bond market will demand a higher interest rate because there's simply more debt covering the same amount of buyers in theory. And would it be sustainable? I mean, the US is an almost impenetrable currency, the US dollar, I would have thought. But could there be any ramifications on that if the bond market at any stage thought, hang on a sec, this is unsustainable, and they don't look as if they're politically able to get it under control? I mean, where do you see this going, Philip Pilkington?
Well, the first thing to note is, to a large extent, the modern monetary theorists, the MMT crowd, are correct. If you issue your own currency, you can't really go broke. So if the government had to issue a lot more debt and the bond markets weren't really interested in that debt, the central bank would step in and buy it. And that's pretty much an automated process because...
would that not lead to inflation? I mean, I understand that quantitative easing is not necessarily inflation, or maybe not quantitative easing, but the central bank essentially buying debt. I mean, this, as far as I understand, would be inflationary if you weren't in a kind of, if you weren't in a deflationary period within the economy, right? I mean, like quantitative easing wasn't inflationary in terms of top line inflation or core inflation, because interest rates were on the floor, demand was still collapsing. Resources were bottlenecked within banks, classic balance sheet recession as banks hoarded money. And it was just overall generally deflationary. So all of this money printing didn't necessarily have an effect. But if you do that when inflation is already kind of, it's coming down now, but it seems that the inflation genie's been released again. It's perhaps under control, but it's been released. And now suddenly, at a time of high employment, so low unemployment, I think it's better to say, and recently decent economic growth, you suddenly have to get the central bank to start buying bonds again? Is that not inflationary? Do you not have to accept inflation?
The inflation comes through the spending itself. I mean, that's how the aggregate demand, as economists say, is introduced into the economy. So the inflationary pressure on the economy, for example, a lot of the deficit that's being run at the moment, or some of it anyway, is Biden's big IRA spending bill. The pressure on the economy comes from like building green battery plants or windmill farms, and then that puts pressure on the labor market. I mean, that's basically how the inflation comes into the system. So some of that inflation has already taken place. The issue is that, as you say, if you're in a more deflationary scenario, then increasing government spending doesn't actually always. I mean, it could. You could get a stagflation scenario like the 70s, perfectly possible, but if the economy fell into recession, my guess would be that you'd see some deflationary forces at first, and so that would kind of offset the additional spending that would kick in from the tax revenues falling and the unemployment claims going up. I mean, I'd say that the risk with overspending is always it's what Britain learned when Liz Truss tried to do that budget. The markets said no. And the threat there was always to sterling. I mean, that's what needs to be kind of understood, that the market said no, and they said, well, I demand a higher interest rate for that. The government could have conceivably turned around to the Bank of England and said, could you please bid that interest rate back down? Now, that would have been complicated by the fact that the Bank of England was trying to was trying to drive interest rates up at the time, but they probably could have managed it. The real issue would have been foreign bondholders would have dumped their bonds. And when that happens, they sell these bonds that they're holding for sterling. And then often they'll flip the sterling, they'll sell it in the foreign exchange markets and thereby drive the value of the currency down. Now, you don't need that much additional selling in a currency market to drive the price of a currency down. The US dollar, as you say, is a lot more resilient than sterling. Sterling's had a long history since 1945, perhaps even before, of consistently falling. There's been a lot of sterling crashes or runs on sterling. We've never seen that with the dollar. But you could say that the US is moving into the position, its economic position in the world is becoming quite similar to post-war Britain. Britain used to have the reserve currency. It used to have the most developed financial markets in the world, and money just naturally flowed to the city of London up until the interwar period in World War II, where it became second best. It was loaded up on debt from the war. It owed America a load of money, and the dollar was ascendant. And at that point, sterling became a relatively unstable currency. And you can it'd probably take two hands to count the number of sterling crises that we've seen since 1945. America may be moving into that position now, with China holding all the reserves, China having all the debt on America, and America engaging in this increasing overspending, or call it what you will. And that would be the concern, that really what might happen is that if we got really crazy deficits in another recession, people could just start pointing at America and going, by indicators, it looks like an over-indebted basket case. And at that point, they might actually start further diversifying their currency holdings. And the dollar could go into that long period of decline that we saw the sterling go into from 1945 up until today. The sterling has never exited that. And that, in other ways, leads to slower equilibrium economic growth and a general feeling of decline that Britain's had, if not since 45, certainly since 1956. That will be my concern, and I'd say that will be the one to watch in the upcoming recession.
Just to add something very briefly to that, we've only fairly recently got over the last US federal government shutdown scare. And with regards to the way that markets might look at the US and their ability to ultimately bring deficits under control, if not instantly, but over the long term, having the political will and ability to, bring the fiscal path towards something like rationality. The federal government in the US will shut down after September the 30th. So at the end of this month, if the Congress is unable to pass a funding bill by that date. And although it sounds, quite a few weeks away. Here we are at the beginning of the first week of September. September the 30th sounds a long time away, but it's only, as of the day of recording, 16 legislative days away. And by the time this is published, 14 or 13. So the US Congress has got about 13 days to come together and agree on how the federal government is going to be funded if it's not to shut down yet again. And I would say that every time the US political, or the actors in the US political system act out like this, it adds another kind of small dent to an already bruised confidence. And if you add to that really startlingly high fiscal deficits that look like they might get worse, and an economy heading, it seems, toward recession, and a few indicators suggesting that there's at least a possibility it could be quite a nasty one indeed. And at the same time, the whole world is bifurcating, and you're kind of sanctioning half of the world and freezing the assets that they hold in your system. Yeah, I mean, I think there are risks. I think neither of us saying this is going to happen, but there are risks in acting in this manner. There are risks in running the economy in this way. And it's certainly something I hope, anyway, that we can keep Multipolarity listeners abreast of.
Really briefly in closing, that there's a general thing. It's something that kind of comes up over and over again on the show. I don't think that there's any credible long-term macroeconomic plan that the Americans have anymore. And you almost feel like economists don't even comment on it anymore. Like in the late 90s or even post 2008, there was kind of a vision of what we should do. In the late 90s, liberalize, make sure to maintain the financial markets intact. Economists would debate actual issues, tax increases, tax cuts. After 2008, the debate became more tilted toward Keynesian economics, intervention in monetary and fiscal policy. And the whole thing is, let's lift the slightly stagnant and depressed economy out. Okay. It just feels to me, since the pandemic, and definitely since the sanctions, that economists just don't even talk about anything anymore. They talk about the latest data point or about a revision to economic data or whatever, but there's no narrative moving forward. There's just no consistent narrative of here's where we are and here's where we're going to. And, people are just kind of like that. You'll see the random article come out in the Washington Post like you did, which is like, these numbers are crazy. And my guess would be there won't be a flurry of other articles. We'll just go back and then no one will talk about it again. And it feels very, frankly, Brezhnev era.
We are fresh from a huge victory.